Hello everybody and welcome back. Well, that was one of those 24-hour sessions that I'm sure many people will want to forget. The markets defended the resistance points and they sold off, which we suspected. The sell-off though was very brutal. There was almost no buying anywhere until we hit the mid volume profile levels, which we'll talk about a little bit later in today's video. There's so much to discuss, and this is a broad market sell-off across all asset classes. See you soon. Well, welcome back everybody to the channel where we discuss stocks, cryptos, and commodities daily. This is for the market close 5th of May 2022. And if you enjoyed today's content, why not consider subscribing and smash that like on the video if you do enjoy the content. 31 here, fear and greed index. It's pretty fearful and it may move into potentially the extreme fear. And I think that will happen if we make a new low here on the Friday session. So watch this. Keep looking at it. Obviously, when there's fear in the street, some people like to reverse that fear, and there are points when you may want to do so. It was a broad market sell-off. There was nothing that was safe. Almost everything was down. Amazon selling off 7.56%. We'll take a look at that later, continuing its downward trend. And we had Tesla down 8.33%, Apple, Microsoft, all of these stocks really getting hurt and giving back most of their gains over the last couple of sessions. If we think about the market as a whole, it sold off from start really till the end, and it even sold off a little bit extra, but you'll notice there was a small rally here at the close of the day. Now, we say the close is key on this channel because that's where Wall Street enters into big positions. And I think they're playing the stats here. Whenever you have a market, let's say, that sells off 4 or 5% in a day, the stat usually is 5%. The market tends to rally in the next session. Now, it doesn't mean it rallies a lot, but it does tend to do so from the stats. And I think Wall Street was picking a little bit up after having an incredibly aggressive sell-off during the retail hour of power into the lunchtime session. As we mentioned, almost no sector was safe. Of course, the more defensive sectors such as utilities, energy with the small breakout in oil, and consumer staples were all up. But anything that had to do with risk, that is technology, consumer discretionary, they were down very heavily on the session. And of course, it was very brutal there. So we've got some stats coming in from members of the community in the Discord room. And this is from Gary, and I appreciate his work as per always. And if you haven't already, come into the public Discord community. The links are just in the pinned description down below. Join in. There's 8,000 of us there, and plenty of people sharing great concepts, trying to keep you out of course, some of those dangerous periods, and hopefully finding some setups that you guys are sharing together. So exceeding 4 weekly closes on the S&P 500. We discussed how we've gone down now for 4 weeks. We'll look at this later on the charts. That's unusual, okay? It doesn't happen that often. In fact, 4 weeks of complete selling hasn't happened since 2011 in terms of being lower low, lower low, lower low, lower low. So these are very, very rare. Now, on average, you'll get around 6 weeks of down, and on average, you'll get around 12% from the top to the bottom, but never more, you'll notice, than 20-ish%. And the market does seem to like to defend these kind of 20% levels. So will this happen? Well, that's a question that a lot of people are asking. Will it go further down? And if it breaks underneath this support, what's the next big key level that we're looking at in the market? Well, we've got 2. And I think both will probably be defended by Wall Street. So just remember, we're currently on a big stat here. If the market breaks down below, which is statistically unlikely, but if it happens, then things get really, really serious in terms of we've got more to fall usually. And on top of that, if we do fall into certain zones, I think there's areas where you'll see Wall Street defending those zones. Now, of course, 50 basis point hike, this is what happens afterwards. You never, ever usually expect incredible markets after a 50 basis point hike. It's rare. It doesn't happen. It hasn't happened for a long time. But look at the 3-month and 6-month stats and even the 12-month stats. They're not that positive. I mean, they are generally positive towards the market, sometimes a little bit negative, but overall, they're very choppy, more coin flip than you're used to in these types of stats. Something to be aware of when you're thinking about markets in the future. The other thing is bear markets without a recession are rare. So when we talked about Wall Street defending zones, if the markets go down further, they will try and defend the S&P 500 bear market technical. That is around 20% down. As you notice, recessions are common. That is, we are commonly in them. A lot of people already say we're in it. You know, we could be, absolutely. But if we're not, and you miss out on rebounds or even miss out on some of these trades, I think the best thing to do in 2022 is to realize that there's going to be a lot of chop and there's going to be a lot of opportunity on mass rebounds, mass speculation both ways, those types of things. So generally speaking, if we go down 20%, you would think the market will try to defend those levels. And that's something that's very, very important. Let's look at the stats of plus 2% days on the S&P 500 followed by negative 2% days. That is not a good stat that we usually like to see. Now, we've had them happen over here on the S&P 500 for 2022. It's traditional these types of things usually occur during very heavily volatile times. Now, of course, +2 by -2, that means there's a huge amount of switch and bait action in these markets. That happened a lot during 2020. If you were trading that market on the way down, obviously limit downs almost every second day there for a little bit. That was really wild. And over here, are we in this one or this one? The ones after, of course, the recovery where we had these big violent swings. That's a question a lot of people are asking. And of course, we want to continue to look at this stat. The more of these types of days that you get, if you get even another one or two, really, you kind of know that you're in, more recessionary territory. This is not good stuff for the market. Having these wild swings both ways shows incredible amounts of fear realistically in the underlying. If we're talking about earnings season, we still are in that. Remember, we've got 73% beats, 1,083 versus misses 398. That's okay. It's a little bit better than you could have expected at this point, but it is declining. So now it's at 73. It was about 76, 77 around a week ago. News to come. We've had some news come out here. A few of these stocks have hit. A few of them have missed really hard. And we've got DraftKings for Friday and a few other stocks, Under Armour, etc., if you're interested in those. Though earnings seems to be taking an absolute backseat to this market. So let's switch things up. Let's talk about the market and all of the things leading into this Friday session. So firstly, we'll talk about VIX. VIX usually defends around that 35. So what that means is that the market hits peak fear, and then usually the market will rally off these kind of 35 zones because everyone's so fearful, and we see a drop in the VIX. It's usually a very good statistic. But where things get a little bit scary is when you come for the second shot. That is, you've hit it, you've rejected it, and then you come straight back up into it. A few of these times we've dropped back heavily, thought about it, then come back up. This is starting to head towards it. So don't expect it to necessarily defend 35 if we go through the key support on the S&P 500, etc. I think that you could be looking at another kind of rise here in the VIX. So be careful there around 35, guys, if the VIX does get there and cracks these highs. This will be a big, big zone. And if that occurs, the market could go into what we call capitulation, which is an incredible, big, aggressive sell-off, even more aggressive than potentially today. And then that aggressive sell-off will be met, obviously, by slingshot demand. Like, basically, people will buy the capitulation. But maybe you don't want to be involved in that one. You want to be involved with trying to pick it up after that session goes wild. And we'll talk about that in a second. Let's move over to the US 10-year. This is going ballistic again, back up at 3.06, new highs for it. To put it in perspective, it's still not up with where it was in 2018. But it's certainly moving through the 3%. And anywhere in this zone here, we expect some form, you would hope, of selling to occur on the 10-year. Remember, this market can't really recover until, in terms of tech anyway, until the 10-year starts to decline. That will show Wall Street is ready to pick up tech stocks. And it's why we've cautioned really in 2022 against tech stocks. We don't like tech stocks at the moment. We love tech stocks, but we have a love-hate relationship with them because our hate is because inflation's here. And while the 10-year is going high, usually it's not the time to own tech stocks. I mean, I'll just give you a hint there. That's the way that Wall Street really works. PCC, put-call ratio, that's still quite high, above 1, showing that there's still a lot of puts being entered into the system. And that becomes important when we do our analysis in just a few moments. Remember, more puts in the system, more fear, more chance that maybe the market will try to defend certain zones to not pay out that fear. Dollar index, big rebound. So it rebounded straight back through. Now remember, there's a support here that got breached. So effectively, all of these shorts here are getting squeezed at this stage. If we breach to the upside, that is, we go through here, expect follow through from the cash market. So basically, the market will continue to rally higher. And you might think, well, that's impossible. How could that even occur considering this has been up so much of a trend? Trends can go a lot longer, and obviously the markets can stay, irrational in some ways before more than you can remain solvent is the key comment. So this pretty much becomes a trap at this stage. Obviously, it's trying to defend this level. If you were taking bull runs, you'll need to be kind of watching it very closely around here, because effectively this is like a max pain. It's moved to the upside. And if cash continues to be king and it continues to rally, let's say it does rally through here and it actually holds different time frame bull runs and doesn't just instantly reject and then sell back down, showing a trap on the top side as well, obviously in the range, then that could mean that more money is fleeing the market. And I would expect that to be really coupled with something like the NASDAQ or the S&P 500 going through the key supports. Without further ado, let's talk about the S&P 500. So the stat we brought up before that Gary shared was basically that we have a series of candles going down. That is, we have a series of weekly candles continuing this bearishness action. And this is where it becomes pretty important, because if we get another follow through, what's happening there? Well, not only have we're basically right where we started the week. I know it seems like we've been on a roller coaster, and we have, but to put in perspective, we're right where we started only a few days ago. It's just that it's been wild around there. So if we close underneath, let's say this 4,100 kind of zone, we're making another weekly close. And you would expect further selling pressure to try to come through here. Now, I mentioned that Wall Street are going to try to defend two levels. I believe they're going to try to defend around 4,050, 4,000, somewhere around that area, probably 4,000. And they might let it go underneath slightly, but they'll try to defend it if it goes down, because that's where markets will defend certain keys. And then the next one is if it keeps coming down, I believe they'll try to defend very heavily around 3,850, 3,800. And the main reason is because at that point, this market enters a technical bear market. Now, usually, traditionally, when I've seen markets go into technical bear markets and they're going to come back out of it, they come out very quickly. That is, it gets defended right here or defended just above and it rallies. And I think you can expect that, like, if the market comes down to these levels, what's probably going to happen is the market will rally relatively aggressively and at least try to make it back up to something like a 50 fib to suck in more money before it makes its next decision, whether that be down or up. So these are all, calculations and things that people will consider. But you've also got to consider that this would be a 38.2 fib pullback of the entire bull run that happened from 2020 lows to 2022 highs. So there's a lot at stake here in the 3,800 in the future, and a lot of people will be looking at that chart incredibly closely. I would expect that if we go down and there's a giant candle going into it, let's say it's a huge, big thing, just speculation, obviously, at this stage. If that occurred, then, you would see some serious buying support, I think, from the algorithms, etc. Let's move over here to the S&P 500. So why are we defending in this zone, or why is the market coming back up here after hours a little bit? I think this area is clearly, there's a lot of structure here. You can tell on the volume profile over in this left-hand side, that's where a lot of transactions have been placed. So we've basically got a midpoint in between our extreme highs, which we warned against yesterday. Obviously, we're not going to go bullish until we breach those kind of highs. And we also knew that it would probably try to come back down into this structure. It overshot that structure at this stage. So that means that somewhere in here, you would have hoped that the market was able to rally. It took out all the stop losses, including the stop losses that were formed after the FOMC run. And it's then moved down and it's rallied up. Now, we're only on 5-minute chart here on the futures market, but I think if you're feeling bullish here on markets, you're really looking for it to get past this kind of zone in the next 24 hours. That is around that 41.70. Because what that will do is it will kind of breach all of this downward momentum. It will put in place maybe this max pain concept down here. And we're looking for the market to go back up through that. If you're feeling bearish on markets, remember S&P 500 is the key, not the NASDAQ. What the S&P 500 does is the most important, and the NASDAQ will just follow it to a degree. So if we think about the false signals NASDAQ gives you, it gives you a lot, just like IWM, the Russell. So we've defended the 20 moving average here. We knew that was a big level. It's sold that zone, not unexpected. Statistics would have a belief that we're going to have a rally into the Friday, But let's take a look at the options around this area. So obviously 4150, a huge area, previous supports all the way through that, and a massive area. 4170, 4180, pretty big, and a break below this zone with a closure, obviously incredibly negative towards markets. Let's look at the max pain here for the Friday. So if Wall Street got their way, they would buy it back up, and obviously they'd go for 428. Now, I'm not sure that they can get 428, and I don't even know if they can get max pain, and they haven't been getting it for the last couple of weeks. You can't guarantee that max pain is going to happen all the time, everyone. It just doesn't always happen. So 415, look at these puts suddenly on this expiry. Look at the 420. So all of these puts have risen quite a lot over the last 24 hours of trade. That is, people are placing negative bets on the market. So if you see positive price action based on your systems, whatever they might be, and you're seeing positive price action and you know there's a lot of negative kind of puts in the system, could that be Wall Street trying to defend and getting that max pain? I think that becomes a trade that you can look at, and that's always the way you want to apply it. If you have this, does it help you say, oh, I think I'm going to buy 410? No, you need the TA number one, okay? Always TA number one. The data or any of these other things, come on top of that. That's always important. So open interest by strike, just to show you a different way. Look at how many puts suddenly are expiring here. We've got 420, we've got 410 or 415, 410, 405, 400, huge 400 buyers in terms of, that's why they'll defend that. And that goes through a few weeks now. So make sure you subscribe because we will cover this on the weekend video. There's a lot more puts than calls through this striking. So realistically, it does make sense based on a lot of stats and other things that they might try to defend. Let's have a look at the NASDAQ. Same kind of sell-off zone, obviously 20 moving average now, a huge level. This is mean reversion. So if you're not aware of that, the 20 moving average is mean reversion. And if we breach through this kind of zone in the future, expect that to be a huge bull move. So that's really, I'm going to have alerts here. I wouldn't doubt that if that does happen in the future, that we've got some nice preparation here that Wyckoff talks about. Also subscribe. I'll be putting out a video the way I use that kind of concept in the future. And yeah, we've belted down into the supports of the previous low that was formed only this week. So it's a big roller coaster ride. Let's have a look at the percentages. That percentage is a 6.36% both ways. So big movement. If I was to guess, I would think that we try to rally through this zone. If the markets are truly wanting to tank themselves though, a low under these lows, that's incredibly negative, and you've got to expect follow through short momentum because it's going to come through into other markets. We'll look at IWM Russell in just a few moments as well. So it's trying to hold up as best it can. This is not the futures market, but it is trying to hold up. It's at 850, and basically I'm going to look at the S&P 500 more as a trigger than the NASDAQ. The NASDAQ itself, remember, the analysis that you do on the other time frame will help you more. It's taken out all the FOMC lows, it's come back down, and we're on the biggest support that you're going to have for buyers. If they want to hold it, they will. If it gets pushed through and then instantly reverses, then of course that was the trap. But at this stage, you're really just looking at closes under here. Close underneath here will trigger, you would think, bigger shorts. And I'm looking at the S&P 500 to trigger potential buys, which is just based on those kind of stats. Gold trying to do its best to really hold up. Obviously, it broke through the downward trend here, which, only had 2 hits in it. Usually with breaks of downward trends, I'll just give you a bit of a hint, you like to have a few. That means everybody sees it. That means when it breaks, it's more powerful towards that slingshot upside. So if you have like maybe 3 to 4, that's usually a bit more smiley face in terms of seeing these. Markets are defending as best they can. They're holding up. This is a big low that I think that the market will probably try to hold above. We'll have to find out. And gold is, I would say, pseudo maybe. It looks super negative on the daily. I'd probably just call it neutral. If you wanted to, maybe bullish on the small time frame, but you're very, very, very guessy there. US oil does look a bit more bullish. It's broken the downward trend, in this case 3 hits. Obviously it's breached. You've got this kind of movement. It has also breached the resistance, at least from the close perspective. It's higher close than any of the others. Close is kind of key here. And the interaction with these smaller time frames, let's go to the 2 hour here, seems to be okay. So basically you'll notice the market has had these resistances and they got snapped and then it instantly came down, snapped off the lows. And I think now if you get another high here, the market's probably going to try to grind a little bit higher. If you get underneath these lows, very unlikely, and it will come, back down, and at that point it's a bit of a crapshoot. So yeah, it looks a bit more stronger than weaker here on US oil. Obviously, bring your own systems into it. Tesla, it's going to do what the market does, but it did have that breakout. Didn't quite get to the 977 resistance. It's just the market was just too brutal in the pre-market action, and it just sold straight off. And we're hitting now some pretty key level of support. Of course, they're going to try to defend, and if the rest of the market does rally, you expect Tesla to go back up. But it is in a bit of chop at the moment, so it may not be for everybody, and I don't think there's a clear direction on it other than it's still currently sell the rips on a market like this. Similar to Apple, Apple's come back down. It's around a support area. If it's going to bounce, it's going to try to do so here. A breach below this level here, very negative, and you'd have to expect Apple, like others, would try to drop through after that zone. Facebook, we have been a little bit more bullish on this one. It's paid off because it's back down to just where it was, so it's not really a super negative trade or anything right now. It is on kind of a support chop. So depending on the rest of the market, if the market can bounce, I would expect Facebook to try to bounce with it, similar to what we discussed. 230 still technically the target there. And IWM, the Russell 2000, this is quite negative. Of course, a new low down underneath here. I don't see how we don't go to the 170. That seems the most likely scenario. And we mentioned Amazon before, and it'll kind of make sense, even though IWM's got nothing to do with that. This sell-off to this level, this is where you would expect defense to come back in, there will be buyers here of some kind. You've just got to suspect it. So this is an important day here for the Russell. We'll find out what occurs there. Now, we mentioned Amazon. I just want to show you on the charts how fast and how aggressive this thing is trying to sell itself off. So we do have, if IWM, let's say, fell down to that level, where would you expect Amazon to be? Remember, the markets are all connected in some ways, and they're all coming towards next zones. So this is an incredibly big sell-off now for this stock. Very capitulating, very weak. And if this market can't defend this level where it is right now, you could expect it to 2100, 2050, that kind of level very soon. So watch out on Amazon. You're trying to catch a falling knife at this stage, and that is very, very difficult to do. Bitcoin just really moving with the rest of the market. We had a look at this on the previous day, and it kept holding that 20 moving average. We broke it down to a 2 hour, and things were looking a bit better. I mean, obviously it had a downward trend here, had a little double bottom. And really what happened there is why you've got to practice a little bit of, stop loss. It just kind of got melted by the rest of the market. I'm not liking what I'm seeing on the crypto markets in general just this year. I think there's a lot of false breaks, a lot of manipulation, a lot of things that you may not like. BTC shorts is obviously rising up pretty heavily here. Again, it's a very tough market in the crypto market. Unless you're on really small time frames, just getting in and out. Fast and nimble would be the general discussion here. If we're talking about anything else, obviously follow us over on Twitter at FX Evolution. Come follow us there. Discord, of course, join the link in the link description down below. And please remember, non-farm payrolls is about to come out. So if the market's going to catalyst a sell or buy, it's going to try to do it off this number. This is the jobs number, and effectively, this is what is going to create the catalyst that gives them the excuse to go in any direction they feel like. So jobs numbers coming out 8:30 a.m., 1 hour before the market. It's going to be a big bit of news, and I expect some volatility here to then follow through whichever direction it chooses. Thanks so much for watching. Please subscribe if you enjoy it, and we'll catch you in the next one. Bye for now.